What's going on, guys? Chris here with Retail Algo Trader. The date is October 1st, and this is going to be a real-time overview for the week of October 1st through the 5th. We'll be using a simulated account to simply annotate the trades we're actively taking, as well as the process of building the trade and to demonstrate the risk reward associated with these trades. All trades will be conducted with a single contract per strike to show the value of profit and loss per contract. Before we look at this week's trades, let's take a look at last week's trades. Alright, let's get right into it. This is AAPL Apple. This is one we traded last week along with AMD, which we'll go over next. Apple was an iron condor with a 28 September expiration. It was formed with a 207.5, a 210, a 222.5, and a 227.5. We had an 80% probability going into the trade of making our max gain of $38. We had an initial max loss of 212. Overall, this total formed a max percent return of 18% on our money that we were risking. We ended up adjusting this trade. As you can see, our initial point, that's where the top and bottom was for our initial iron condor. What happened was this went into the money, and it looked pretty bullish at the time. As you can see, Friday closed out bullish, so we actually would have lost if we didn't adjust. So we ended up adjusting that trade. We closed out the call side of our iron condor, and what we did was we opened an additional put spread, another put vertical. So we ended up having two put verticals as we went into Friday's close. What that did for us was we took in an additional, we closed it out. Well, first of all, we closed out for the call spread for a $106 loss, but we still had positive credit on our put side, and we took in another $44 on our additional put spread. So this totaled out for a $46 loss on the entire trade, which this went into the money. We actually could have lost our max loss of 212. So instead of losing 212, we ended up losing only $46. So that's how we adjusted the trade to reduce our loss, just by taking in another put vertical here. All right, so let's get into AMD. All right, so this is Advanced Micron Devices, AMD. This is the second trade we did last week. With this trade, we did an iron condor, just like Apple, with a 28 September expiration. It was formed with a 29, 29.5, 34.5, and 35. As you can see annotated here by our top marks, that defined the top and bottom of our iron condor. We ended up closing out of the money, so right where we wanted to be, and we ended up collecting the full premium on that trade. With that trade, we had a probability of 80%, just like Apple, with a max gain of $12 and a max loss of 38. This totaled out for a 32% return on our money, and we ended up collecting that full 32%. So we took 100% efficiency on this trade by collecting the full credit that we could have. Alright, so Apple and AMD, those are the two trades we took. We did talk about in the prior video of taking Nike for earnings, but I totally forgot to take Nike. I wish I did. It actually ended up being a very dull earnings, so an iron condor would have paid out very well, but I think it was Wednesday that they posted, and I just forgot to take the trade. I didn't have it on my mind. I was doing other things. So I wish I would have took that trade. It would have been a good trade, but we did not take that. So AMD and Apple was the only two trades that we ended up taking. All right, so let's look at this coming week's trades. All right, hey guys, first trade we're going to take this week is EWZ. That's the MCI Brazil ETF. We're looking at the daily chart here. We did have a directional indication with a pop flop indicator a couple, last week, maybe 2 weeks ago. So that move is kind of played out. What we're going to do is we're going to go with either an iron condor or an iron butterfly, depending on where the premiums are. So we're taking a look at our options chain here, and we're currently at an IVP of 94.4 or 84. So we're very high. We've traded EWZ a few times in the past couple weeks. As long as IVP stays high, we'll keep trading it. With a float of 1.69 million, so it's sort of low. This can kind of move pretty sporadically, about $1 or two up and down in one single day. It has a 1-year max move of $2.69. So we'll take a look at the options chart. The spread I'm looking at taking is going to be a iron butterfly, just based off of the premiums here. An iron condor wouldn't really pay out too well. It would give you a high probability, but the credit you would take in would be pretty small. So we're going to go with an iron butterfly. The iron butterfly I'm looking at taking is a 33.5. That'll be our sell point. So we'll sell the 33.5 by selling the put and call. So we sell our call and we sell our put right there. We're going to use the 70% probability marks to mark where our protection will be. That's where we're going to buy, go long for the other contract to define this iron butterfly. So 35.62, we'll go with the 35s. And then on the bottom side, 31.38, we'll go with the 31s. So right there, that defines our iron butterfly. And that again is 33.5 for our shorts, and then 31 and 35.5 for our longs. So if we factor in the amount of credit we took in, we have 57 plus 56 minus the debits we paid of 4 and 6 brings us to about 103. So we'll probably put our fill limit order in here for $1. And with a $1, our max risk, we're looking at $50 strike differences here. So our max risk will be $50. That's the most we could lose on this trade. The most we can make would be 100. So it's actually a 2x or 200% return on our money if we end up making the full premium. We likely won't because this will likely fluctuate. So we'll go ahead and plot our break-even points. With a $1 credit that we took in and us being short at our 330 or 33.5s, to factor in our break-even points, you'll just add that $1 credit to both sides. So we have 34.5 and we'll have our 32.5. And so those yellow lines now define our break-even points. So as long as we stay in between those yellow lines, we will make a profit. If we go outside those yellow lines, we will start to incur a loss with a max loss of $50. That's the most we can lose. The max we can make, again, is 100 or somewhere in between 0 and 100. All right, so we'll go ahead and enter this trade, and that will be a $1 limit order. So we'll go ahead and put that in. And we immediately got order filled. Let's go to our manage tab and check just to make sure. So yep, we see right there that we did get filled for that $1 credit. All right, so we'll go ahead and we'll move these around so we can see just the flow sequence. Or actually, we'll go ahead and we'll add them together, and that'll define our iron butterfly once we add them all together. All right, so we just add them all together. You can see spread says iron butterfly. We took an initial credit of 104. That's just about what we got filled at. And with a max loss of 50, this should turn out to be a pretty good trade as long as we stay within our break-even points. All right, so let's take a look at the next trade. All right, hey guys, second trade we're going to be looking at is ticker symbol C. That's Citigroup Incorporated. C has not given us a directional indication with our pop flop indicator, so we will be taking a neutral strategy with a current IVP of 78.97. So our implied volatility is pretty high. The float is 2.5 billion, so not expecting too crazy volatile moves other than earnings. Earnings for Citigroup is supposed to report October 12th, I believe, so not this week. Nothing to worry about this week. That's probably where the high implied volatility is coming from, just the anticipation of earnings. So with no directional indication, we'll go with an iron butterfly or an iron condor. We'll take a look at our options chain to see what would be best. So if we're trying to get high probability of 70%, we'll look at the 74.5s and the 70s just because they'll put us right where we need to be. And it looks like we have $2, probably about a $2 credit there, and roughly a $2 credit there. So $4 would bring us to $4 max profit with $46 max loss. That's a horrible return for the amount of probability. So actually look to take an iron butterfly on this trade. Current price is 72.38. So we'll go with and sell the 72s, just slightly under current price. So we'll sell the 72s. That's the 72 call and the 72 put. And we'll use a 70% probability marks to define our top and bottom side protection that'll establish the top and bottom side of our iron condor. So we'll go with the 70s. So we'll buy the 70s. And on the top for the call side, 74.5s. So we'll buy the 74.5s. To factor in our limit order, we'll use the bid and the asks. So current bid for our shorts would be 90 plus 50 for a total 140 minus the debits we will pay of 11 and 10. So a total of 119. So we'll plug in our 119. We'll go ahead and place this order. All right, so we got order filled. Let's combine all these into an iron butterfly here. So we'll just combine them all. We can see we took in our credit of 118. I actually had to I paused it and had to drop it 1 cent just to get filled. It was not filling me at 119, so we did get filled at 118. So we'll go ahead and plot our break-even points. Being that we are short on the 72s, we will add and subtract $1.18. So 72 plus $1.18 will give us 73.18. So if we add here 73.18 and we take 72 minus $1.18, and that'll give us 70.82. And that will define our iron butterfly. So those are our break-even points. As long as we stay between 73.18 and 70.82, we will make some sort of profit. If we stay in around the middle of that, we will likely collect closer to the full premium of 118. If we start to break out of that range, that's when we'll start to go into a loss. But the benefit here with the $50 strike differences is our max loss. All right, so our max loss for this trade is to define that, we'll actually take a look here. We took check our manage tab. We took a 118 credit again, and so we'll use our long 74.5 minus the 118 we took in minus where we're short out of 72 for a $132 max loss. The bottom side, the put side max loss will actually be 72 minus the 70. That's where we sold, and then minus the 118 credit we took in for $82 max loss. So the max we could lose on this trade will be 130. The max profit we could take in will be the credit received of 118. So that is Citigroup, and we'll see you for the next trade. All right, last trade we're going to look at here is AMD. That's ticker symbol AMD for Advanced Micro Device. We're not getting an indication on our pop flop indicator for directional, so we will be betting neutral. And with a IVP of 82.29, we have traded this a few times in the past few weeks, but I mean, as long as implied volatility stays high, we'll keep trading it. No reason not to. Earnings is not this week, so nothing to worry about there. So we'll go ahead and take a look at our options chain. With a float of 962 million, this is not too volatile. 1 year plus or minus max move of $2.89. So looking at this, if we try to stay in the 70% probabilities, we would need about a 34.5. So we go down 34.5, as we can see there's only a $2 difference between the bid and ask. So not much credit to receive there. We would have to put in a custom limit order to try to get filled outside of that. And there's no guarantee that we would get filled at that. So what we're going to do is we're going to actually sell another iron butterfly. That'll be the third one for this week. So what we'll do is current price is 31.67. We'll go with a 31.5. That'll put us just slightly under current market price. So we'll sell the 31.5 calls and puts. And then we'll use our 70% probability marks to define our top and bottom side protections of 34.5. So we'll buy the 34.5, and then we'll come down to the bottom and we'll sell the 29 because it's 28.89. So we'll sell the 29s. All right, so to factor in what our limit order should be, we'll take in the bid, we sold the 31.5, so we'll take in those bids of 93 plus 78, and we'll minus the debits we paid of 15 and 13 for a total of 143. All right, so again, we're taking the bids of what we sold of 93 and 79, and we are minusing the debits we paid of 15 and 13. So that is a 144. So we plug in 144 and we click yes, submit this order. You can see we got order filled because we basically just took a market order via a limit order. So to factor in what our max loss would be here, we can go ahead and we can actually rerun that trade and it should just tell us. So we'll plug in bid, and ask of 144. So we can see our max loss will be 156, and basically what we're doing is we're looking right here. Max loss of 156, max profit of 144. So pretty good risk reward here, right around a 1-to-1. To factor our break-even points, what we need to do is we take our 31.5s and we minus the credit we received of $1.44. So we'll take our 31.5, that's where we sold short, and we'll minus $1.44, and that gives us 30.06. So 30.06 will be the bottom side break-even point, and then for the top side, we need to do 31.5 plus the $1.44. That'll give us 32.94. So when we plug in 32.94, that'll give us our top side. So as long as we stay in between these two yellow lines, by Friday we will get some sort of profit. If we break outside that, we could start going into loss territory, but we can always manage a trade to reduce loss, just how we did kind of last week with Apple. So we don't have to take that max loss. We can always reduce that loss by turning this trade into another vertical, turn it into an iron condor, whatever the situation may be. So right now we stand to make a variable profit as long as we stay within this range. So that is ticker symbol AMD, and we traded C as well as EWZ. Those are the trades for this week. Have a good week, rest of your week, and we'll see you next week.